Thank you all for joining. I'm Craig Sherman. This is Giri Sreenivas. And it's actually good that we got a small group here because this is a workshop. This is not a lecture. And we want to make sure that this is as interactive as possible with a smaller group, more intimate group. Please dive in and ask lots of questions. We want to walk you through. Is it working? We're just going to walk you through a term sheet, a typical term sheet for both an angel and a venture capital financing. We'll talk about the terms that are important. In particular, what we want to do here is focus on understanding what terms in a term sheet are negotiable and you should negotiate, and which terms aren't negotiable, don't waste your time on because everyone will get mad and embarrassed and laugh at you. So I'm a corporate attorney at Wilson Sonsini. I work on early stage financings like this on a regular basis, M&A, public offerings, and we want to bring a real person to this, not just a lawyer. So Giri Sreenivas is the founder of mobilisafe, and Giri has been through a financing recently and can talk a little bit about his experience actually negotiating a real term sheet.
Sure. So thanks, Craig. Craig and I worked together actually on our Series A financing. I was co-led by Madrona and Trilogy, so we had a little bit of two-for-one action in the negotiations that maybe we didn't anticipate going into. So I don't claim to be any kind of expert, but I'm happy to give you guys insight into what my experience was like and talk a little bit about the Seattle market and the Bay Area market and how to go from being fundable to getting funded.
Okay, so we're going to spend a couple of minutes first talking about the term sheet, what the term sheet is all about, how you get there, sort of the overview of the process. And then from there, we're going to dive into an actual term sheet. So on each table, there are copies of these slides. So if you want to follow along in the slides, that's there for you. There's also a copy of a term sheet, and that's a term sheet that we will walk through and focus on the important issues. And then the last thing that's on each table is some market data. Our firm works on several hundred venture capital financings every quarter. We take all that data and aggregate it in a database. So we can track the trends on a quarterly basis. This publication comes out quarterly and gives you a breakdown of a lot of the terms that we're going to talk about. So when we actually start walking through the individual terms in the term sheet, you can refer to this and kind of see what the market is. And that's what's really important here. When you're negotiating these deals, it's really important to know what's market, what's not market, what's worth negotiating. So why don't we first talk about how you get to a term sheet and sort of the process of getting there. You know, how do you kick off the process? I'll have Giri talk a little bit about that based on his recent experience.
Sure. So I'm sure since you guys are all here, you're working on something or thinking about working on something on your own. So, you know, one of the key steps that we took in getting involved in the process was finding a good advisor, and in particular an advisor that has raised money before and raised the kind of money that you think you're interested in. So if you're thinking initially you want to go after angel money, try to find an advisor that's done that. If you want to go after VC money, likewise. And then the other thing that we did very early on was find counsel. And so we spent quite a bit of time going around town interviewing folks. Been very, very happy with Greg and Wilson. Just kind of recommend you guys do your diligence. And part of the reason I say starting with an advisor and counsel, and in many ways your counsel in the early days will be an advisor to you, is because you're going to need to get introductions. And there are certainly folks that you'll know through your network, but an advisor and a lawyer can certainly help you get in front of a lot of folks. And depending on the kind of money that you want to go after, they'll have different kind of networks that are available to you. And we'll talk a little bit more about what kind of money makes sense and what stage. But the key things to keep in mind, get feedback from your counsel, get feedback from your advisor on what your materials are as you make the approach to these folks. You want to have some kind of an executive summary, pitch deck, all these things I'm sure they talk about in some of the other sessions. But I think those are some early good steps just to know what's out there and who you want to talk to.
Do you want to talk a little bit about sort of angels and VCs? When you're looking at raising money the first time, how do you decide whether you want to talk to angel investors, whether you want to talk to VCs? Should you talk to both at the same time? What are your thoughts based on your experience?
Yeah, so we talked to both at the same time. And it's interesting because our advisor gave us a lot of feedback to go ahead and just focus on angel money first. And, you know, we also talked to some other folks and kind of got to a mix. And I would say my suggestion is to do both. Unless you have a very clear milestone that you think you can get to on angel money and you're not susceptible to ups and downs of the economy, I would say talk to both and see who you get comfortable with and why, because they each have different pros and cons. We'll talk a little bit more about that later, but what I appreciate about talking to both is you get different perspectives. You start to learn about how they can help your business move forward. Ideally, you want to find people who are interested in your company, not just because they want to put money somewhere, but because there's some additional value add. And angels and VCs have very different kinds of value add, in my opinion. I think just to make it local and talk about doing this in town. A lot of the prominent angels tend to know each other, just like they do in the VC community. So when you start going out, word will get around I would say pretty quickly. So it's something to keep in mind. And I think a lot of VCs in town and even in the Bay Area are experiencing deals that they're losing out on to angels and sort of super angels. So that can actually work to your advantage, and that's one of the reasons why you may want to talk to both in parallel. Because competition for your deal is something that can be very beneficial to you for terms, and just I guess your overall happiness with the deal that you get.
So, do you want to talk a little bit about that competition issue? How do you manage the process to make sure that you don't have just one player in the game and they can impose whatever terms they want?
Yeah. So the process is probably one of the most stressful things you'll go through. It's not easy. There are lots and lots of ups and downs, and it's a little bit like dating. So you really want to get a date with a bunch of different people, and you just never know if they're interested in you or not. So what I would suggest is, what we did was we just had a massive spreadsheet, and we kept track of, for every single investor, like what stage of the conversation we were in, and we would regularly check that, if daily, if not even more often than that. And so what you want to do is you want to try to keep each of the pipelines in relatively the same state. So if any one investor gets further behind than the others, you can always use that as motivation to help them move forward. And one of the tricks that we did was to say, look, we're getting to a certain point in the discussion where we're talking about A, B, and C with some other folks. We really like you guys. We'd like to figure out a way to help speed the conversation up. And what that does is it can help you avoid a slow no, right? You'd much rather get to a quick no if there's no interest. So anyway, it's a little bit, it's chaos, and it's not easy, and it really depends on how broadly and how many people you want to talk to. I think, we ended up talking to somewhere in the neighborhood of 20 different investors, and we had a pretty good hit rate in terms of interest before we finally closed. But I've met with folks who have talked to over 100 investors before they got their first yes. So just to give you an idea, it can take a while. It is very distracting. You will feel like your business is not moving forward while you do it. And the contrast is the investors expect to see progress while you're trying to raise money. So you have to figure out a balance of that.
So how long did you spend between coming up with the idea, then starting to have those first conversations with potential investors, and then actually getting to a term sheet?
Yeah. So my process, I think, was a little bit unusual. I was employed full-time at a company. I'd come up with some ideas. A venture arm of that company had introduced me to an investor just to get some feedback. That kind of pushed me over the edge and made me feel like I was fundable. And from there on, it was sort of all out. Let's go figure this out. So we didn't start pitching in earnest until late January of this year. We had to do a pivot in early March, and I think we got that term sheet in mid-April. So that gives you a rough idea of timelines. Between the time that we first started pitching and we did our pivot, what happened was the investors that were very interested in us got to know us. And so you may be impatient about the process, but you have to recognize it's a very personal thing, and your investors want to get comfortable with you, not just the market that you're in, your approach, and your business. And a lot of people say it's a more serious commitment than getting married. You're going to be working with these people very closely for 5 years, 6 years, 8 years, 9 years, depending on what your outcome looks like, and you can't get divorced. So it's a pretty big commitment.
Well, you can get divorced. But we'll talk about that later. Some of the issues around getting divorced, but yeah, you don't want to get divorced, but it does happen more often than people would like. Okay, great. So again, we're going to go into the details later, but maybe we've gotten you through the point where you kicked off the process, you talked to a variety of potential investors, you're setting up a competition between various investors. How do you gently move the process from competing potential investors, either all VCs or a mix of VCs and angels, to putting together a syndicate and actually lining up your investors into a single deal?
Yeah, so the most important thing is finding your lead. And this is probably the hardest part of the process in managing the pipeline, is getting the first person to say yes, getting the first person to indicate that they're going to give you some kind of a term sheet. Once you know that that's coming, then you can start to think about syndication. In fact, a lot of investors will say, we like to work with these people, or we like to work with these firms. And it could be a mix. Some VCs will like to work with other VC firms, or they like to bring in specific angels, or they'll have carve-outs in the round to give you an opportunity to bring in angels. I think you need to think about what kind of mix makes sense for your business, and what kind of folks you want to have involved. I would say, one important thing to keep in mind is, and we'll talk a little bit about this later, is what is the distribution of your board. And I think that has an impact about how you think about syndication as well. Early stage investors, they're taking a pretty big risk, and so they want sort of rights commensurate with that. And so the more folks that you have involved in a syndicate, the more complicated things can get potentially. And the other thing you'll run into in Seattle, I think, which is different from the Bay Area, is because everybody knows everybody, whether you like it or not, folks are going to talk about syndication. So if there's interest in your deal, and they know you're going out around town pitching for things, that conversation is going to happen. You may as well try to facilitate it or try to get in front of it and bring it up if you feel like things are going positively with multiple firms. I think it's a little bit different down in the Bay Area if you're trying to raise money from there or from Boston, because you have different groups of investors that like to work together, and so you could potentially levy different groups against each other.
Okay, great. One thing I should have done at the very beginning is have Giri talk a little bit about his company and where it is today. And one important thing I should mention is that Giri's beta launched several hours ago, which means that Giri did not go to sleep last night. So he has been he worked all day yesterday, he worked all night last night to get his beta launched. He came over here, he went home for 5 minutes to shower before he came over here. So we can thank him for that as well. But really want to thank Giri for participating in this, even though he's in the middle of his product launch, and today's the big day. So congratulations to him. But maybe Giri can talk a little bit about what mobilisafe does, what the company's all about.
Sure. So in a nutshell, we're helping companies understand and manage the risk of personal mobile devices that are coming to corporate networks. So what that means is there's a trend that people are talking about called the consumerization of IT. I tend to think of this as part of a much bigger trend, which is the individualization of technology. So people are making technology choices, they're more savvy about them than they were maybe 5 or 10 years ago. And so IT departments are in a position now where they have to deal with employee choices as opposed to being prescriptive about that. So we're focused on mobile security as a service kind of a solution. Helps companies really get a handle on all the different kinds of devices that are out there and what that risk looks like for them. Like Craig said, we just launched a private beta program today. And things are moving quickly. So.
Okay, great. So let's talk a little bit more about what a term sheet is. One of the important things to be aware of if you're kicking off this process, and maybe we should have people raise their hands, how many of you have actually been through the process? How many of you have started a company and raised money? I think that's it. One. From angels or from VCs? Okay. So you've seen something like this before, what we're talking about. Great. So for most of you, this is fairly new then. So when you're heading into this process, one important thing to be aware of is who drives the term sheet. If you are going to raise money from venture capitalists and you show up at their door and say, here's my term sheet, please write a check, they'll laugh at you and ask you to please leave. You do not tell VCs what terms they are investing on. They will tell you. So you go through the process like Giri went through. You present the company. You talk about the business. You have meetings that go over a period of time, anywhere from 3 weeks to a month, best case scenario, much more often 6 months to a year, sometimes even longer than that before you get to a term sheet. And eventually, when the partners of the fund approve it, you'll get a draft term sheet and then you start negotiating. With angels, it's the complete reverse. When you're going to angel investors, they expect you to give them a term sheet. And the term sheet, the terms of angel investments as opposed to venture investments really aren't that different. And when we get into the details, we'll talk about some of the areas where the terms may differ. Angel investment terms tend to be a little bit more favorable to the founders of the company. On the other hand, well, valuations really vary across the board. It used to be that the assumption was angels would invest at a lower valuation and VCs would give you a higher valuation. I'd say today it's all over the place. And there are angels and super angels, particularly down in Silicon Valley, who are investing at pretty high valuations. But it's important to keep in mind as you're heading into this process whether you need to be putting together that term sheet. If you're doing the parallel process like Giri did, you're not going to walk into the first meeting with an angel necessarily and say, here are our terms. But once you've been meeting with angel investors, once people know that you're raising money from angels, they are going to expect you to walk in with the terms, and that's not just valuation. It's all of the things that we're going to talk about when we get into the details.
I just want to add one quick thing to that. I think whether you're talking to angels or VCs, one of the hardest things that we found to figure out is exactly how much money you want to raise. And it will vary by the kind of investor you're looking for. We had what I'd like to call sort of a go slow plan based on raising less money from angels, and a go fast plan raising a little bit more money from VCs. It's important to think about that, and there's a lot of great writing out there on the web about how much do you raise and what are you raising for and what kind of timeline. We like to think about it in terms of milestones, so we thought about a go slow milestone and a go fast milestone. I think that ends up having a pretty big impact in how you have those conversations. We met with angels that would ask us these questions about terms and amounts, and so that was a little bit of a sliding scale for us, but I think negotiation-wise, it's one thing to say how much you want to raise, it's entirely another thing to talk about at what valuation and with what terms. And you can choose to be forthright about that, or you can let the investor bring it up. I think it kind of depends on how the conversation goes.
Yeah. And one of the odd things about valuation discussions and the amount you're raising is that things work backwards from the way that you might expect. And the amount of money that you're going to raise works backwards into the term sheet to determine typically what all the other terms are. So if you're raising $2 million, your valuation is going to be, $3 to $5 million probably. If you're raising $5 million, your valuation is going to be $7 million to $15 million. I mean, the investors are focused on percentage ownership post-financing. How much of the company are they going to own? Angel investors are typically looking as a group to own somewhere between 10% and a third of the company post-financing in the aggregate. VCs in the aggregate, again, sometimes you only raise money from one VC in your first round, sometimes it's two or more, are looking to own somewhere between 20% and 45% of the company after the first financing. So VCs are typically looking for larger ownership. And again, they're going to work backwards from that amount of money you tell them you want to raise into what your valuation is based on their expectations of ownership. And most venture funds have no reason for it, but they typically are looking to own at least 20%. So if you're working with a larger fund, if you're going to have more than two investors, it often is hard to get the two investors to own less than 40% together because they will be telling you, it's not in our bylaws, there's no reason for it, but we need to own 20%. It's not worth our time if we don't own at least 20% of the company. Again, sort of some of these odd VC math things that you need to be thinking about. Okay, let's talk a little bit about what the term sheet is all about. Most of what we're going to focus on here when we get into the details is a preferred stock term sheet. But raising money by selling preferred stock to your investors is not the only way that you can go. There are really three primary ways that you can raise money early stage from investors who you expect to be equity investors. The first and maybe the simplest is just doing common stock. When you start the company, you issue stock to yourselves as founders. That stock is common stock. You can issue common stock to your investors, And it's simple in that you don't have to negotiate a lot of terms. Common stock is common stock. All the stock in the company is the same. There's no liquidation preference, and we're going to talk about liquidation preference when we get into the details. They're typically not special voting rights. Everyone's in the boat together. The problem is valuation. The biggest issue is valuation. And part of that is negotiating what your valuation is going to be and what that right valuation is. Part of it is one of the joys of a startup company is that you can grant equity to employees at a low valuation. The IRS has recognized that if you've got preferred stock that's issued by a startup company, that preferred stock has all of the terms that are in that term sheet on your table. It's got liquidation preference, meaning they've got the right to get their money back first. They normally have special voting rights. They may have redemption rights, a whole bunch of special rights that make the preferred stock better than the common stock. And that means that you can justify issuing stock to your employees, either outright as stock or granting options to your employees and your advisors at a much lower valuation. So private companies can do something that public companies, that Microsoft, that Google, that Amazon can't do. They can grant equity to their employees at a much lower valuation than the investors are paying in their shares if you do a preferred stock deal. And if you just done common stock, that won't work. So that's why typically we tell people don't do common stock deals, because you want to be able to get cheap equity in the hands of your employees. Now, what if you don't want to even go to that much trouble? What if you want to keep things really simple? What is becoming more and more common these days is what's called a convertible note deal, a bridge deal. There are a number of terms for these early stage note financings, where instead of negotiating all the terms we're going to talk about here in detail in a preferred stock financing, you defer all that and push it into the future and say, we're going to raise money from investors and we're going to give them a promissory note. You give us $500,000. We agree that in 2 years we'll pay you back that $500,000 plus interest. But if we do a financing, and we do expect that we're going to do an equity financing normally with big angel investors or big venture capitalists, these notes will convert into equity, normally at a discount and maybe with some extra special benefits. And the advantage of doing these convertible note structures is that they're really simple. We're talking about 3 to 10 pages of documents instead of about 100 to 150 pages of documents for a note financing. And lawyers don't quite get paid by the word, but pretty close. So that means that your costs are going to be a lot higher for for a preferred stock deal than for a convertible note deal. The legal fees on a convertible debt deal are typically somewhere between a couple $1,000s and $15,000 on the high end. A preferred stock deal could be anywhere from $15,000 in legal fees to $100,000 plus for a deal that has a lot of problems, where there are a lot of issues to work through. So a convertible debt deal can be a great way to go if you can convince your investors to do that.
I'll add one thing about the convertible note. So there's a notion of a cap, and what that effectively does is it prices you around. And it's something to be aware of if you go down the convertible note path. So with a Series A kind of financing, you're definitely going to have the round price by an investor. The goal, like Craig was saying, with a convertible note is to try to push that out. And one of the reasons to push it out is it's very hard to price an early stage company. It's just very difficult to do. A lot of the times it works out to this sort of reverse math problem, which not a lot of people are comfortable with, in particular not a lot of founders are comfortable with, which is why things are getting pushed out. So you'll see that there are some folks that are doing convertible notes without a cap, particularly the folks that are now follow-on investors for programs like Y Combinator. I haven't heard or seen that in Seattle. I don't know if that's actually happening right now, but it's one thing to keep in mind that if you actually go down that path, be mindful of, even though it's a convertible note, even though you're deferring a lot of things, you are more likely than not going to sign for some kind of a cap. And what that means is you're effectively pricing, okay, if I raise $500,000 on a $2.5 million cap, if you were to close your next round of financing at that valuation or above, what the angels have done is they've locked in a certain percentage equity in the company, regardless of how the round is. Now, if it's less than that, then you're okay, right? The cap doesn't kick in. So, yeah.
No, it's a great point. And I would say 2 or 3 years ago, convertible note deals as a first financing, prior to an equity financing, were extremely unusual in Seattle. You would see them more often in Silicon Valley. You would not see them very often. If you talk to most of the angel investors in town, if you talk to the Alliance of Angels, they would say, we won't even talk to you. If you walk in the door with a term sheet for a note financing, tell your lawyers to go to hell. We don't do those deals. You're wasting your time. It's got to come back for a term sheet with a price financing. Yeah, we'll only do an equity deal. And that's really changed, and that started down in the Valley where convertible notes have become more and more common. We've done more convertible note deals in the last couple of years in Silicon Valley than we've ever done in the past, and that trend has really moved up to Seattle now, where these convertible note deals, which were not quite unheard of, but were very unusual early stage, are quite common now.
And sorry, two other points about these. One is the notion of high resolution financing. So if you're not familiar with Paul Graham, totally recommend reading his articles. He's got a great one on something called high resolution financing, which is, let's say you're raising a $500,000 round. If you did it in $50,000 or $100,000 increments, what you can do is on a per note basis, you start to bump up the valuation. And so your net valuation ends up being somewhere in between where you started and where you finished. It's a great approach. I know some folks that have employed it pretty successfully in the past 6 to 9 months. And I think angels tend to be pretty comfortable with it as long as you're showing progress along the way. It's one thing to say, I raised it at one valuation on Monday, and then on Tuesday I bumped it up just because I got some money in the bank. That may not be the best approach, but I think if it's milestone driven, it can be meaningful. The other thing I'd add is the cost of financing relative to the amount being raised, and that's one of the reasons why convertible notes have become much more appealing. You can get them done much more quickly and at a much lower percentage than the amount of money that you're raising. And I think it's important to think about what percentage of the company do you want in the early days to be dedicated to just getting the company formed. It can be pretty significant. So it's important, and you want to set yourself up so that when you do successive rounds of financing, you have a good framework in place. So I wouldn't necessarily advocate one over the other, but it's something to think about.
Plug it or find another power source. Thank you. Plug. There's a wall socket. There we go. It says it's plugged in. That's on. What is this? Back on.
There's a wall socket right here.
Yeah. Can't quite make it. Anyone bring an extension cord?
Let's do it this way. Yeah. I think if you take it around.
Thank you. Saved. Yes, Connie.
So what is the range of a convertible note in terms of the amount of money?
How much would we typically see raised?
Yes.
In the old days, for an early stage round, I'd say a couple $100,000.
Okay.
Currently, I had never seen this before, but we just did a $2 million convertible note to start a company. So it's changed dramatically, in part because angels are willing to invest larger amounts than they used to, and in some cases maybe be replacing the venture investors, in part because the venture rounds that follow are often expected to be larger. So there's no hard rule, but you wouldn't want to have more than, say, 20 to 30% of your eventual financing be old money that's converting into equity.
And what's the interest rate?
8%. 8. I have no idea why. It's always 8%. It's one of these odd things. And I'm absolutely serious. Sometimes it ends up being negotiated. It doesn't matter what the prime rate is. It's always, we just put in the number 8% in the term sheet, and everyone says, okay.
It's a discount that ends up being the negotiable element there. So when it converts, if you have a discount, is it 10%, 25%, 5%?
Yeah, because the 8% that interest doesn't actually end up getting paid if all works the way it's supposed to. It ends up converting into stock, so that 8% is effectively part of the conversion discount. So normally these things convert at a discount. So if your Series A investors, once you get to the Series A, pay $1 per share, then the investors in the bridge note, if they've got a 20% discount, will end up taking 80 cents of every, instead of paying $1 a share, they're paying 80 cents a share on the conversion of that note. So they're getting more shares per dollar that they put in based on the 20% discount, plus they're also getting the 8% interest. So if the notes were outstanding for a year, they'll get another 8% discount on top of that. Again, I have no idea why it's 8%, but it really is always 8%. We just fill in the blank, yeah. Okay. So let's talk about the term sheet. We're now going to dive into what we wanted to talk about. Does anyone else have questions about debt? Because we're done talking about debt. We're going to talk about just preferred stock. Okay, let's dive into the term sheet. You all have a copy in front of you. It's long. I mean, what we've handed out to all of you is sort of the Wilson-Sonsini standard form. If you guys want to play with this, this all came out of a term sheet generator that's on our website. If you go to WSGR.com, you go under venture capital. It says areas of practice, venture capital. There will be a link to a term sheet generator. And there's an online system that will walk you through a term sheet, and it will ask you all the questions. It will say, what kind of liquidation preference do you want to have? And then it will give you the choices on the types of liquidation preference. It also, online, has links to the data that I distributed, the glossy handout. So all of that information is integrated into this term sheet generator, so you can see what market terms are in recent deals. And so I just took that term sheet generator last night, or maybe Sunday night, and filled in some blanks and dumped out a term sheet for you guys to take a look at. So that's a great way to play with this. So we've given you this long document, and it looks like there are tons of issues, but there aren't tons of issues. There are 2 issues. Every single thing in this term sheet is about one of 2 things. It's about either money or it's about control. I mean, it's pretty simple. That's all you're negotiating in the term sheet is you're talking about, what are the terms of the money going in, and under what conditions does the money go out, and who gets how much money when the company's sold, when the company goes public, when the company shuts down and goes out of business. So those are the money issues. And then you got the control issues. How are decisions made in the company? How is the board of directors set up? How does the board make decisions? How do really important decisions get made? If the company is going to be sold, who has the right to say no? And under what conditions can they say no? What leverage do people have when you get to that point? So we've got this list of issues we're going to talk about. And we're basically just going to walk through the term sheet and give you our thoughts on how these issues are negotiated. Let's start with the number one issue that everyone thinks about, valuation. And you look at this term sheet, and it looks really simple because on the first page, item number 3, it says valuation of the company, $5 million pre-money. Oh, it's really easy. It's just $5 million pre-money. But it's actually more complicated than it appears. Maybe Giri can talk a little bit about it based on his experience. Maybe not based on your experience. You can generalize.
Yeah. So you mean in terms of how that's...
You don't have to say what the valuation of your company was and what the negotiation...
How that number's arrived at?
Yeah, how that number's arrived at.
So, okay, so I have a perspective. I think it's an opinion. I think you should take it with a grain of salt and get lots of people's opinions. But it's in vogue now, I think, to try to push valuations really high when you raise money, just so that you're not giving up a lot of your company. And I think that there's a good reason to do that. I think it's got to be balanced against understanding how you need capital for successive rounds of the company, or successive milestones for the company. So, for example, if you were to have a very high pre-money valuation for your initial round of funding, what you've done is you set the bar very high when you want to go raise your next round of funding. And there are some good things about that, and there are some bad things about it. But I think Craig covered some of the key things, that when you signal how much money you want to raise, what you're effectively doing for a lot of investors is signaling what you think your pre-money valuation could be or should be. And I think it's important to have an understanding of market and for the business that you're in particular. So, for example, for a lot of consumer web startups, consumer mobile startups, there's a strong expectation now that people are bootstrapping for a while, that they have a certain amount of demonstrable traction before they can have a certain kind of conversation about valuation. For other kinds of companies, it's a completely different ballgame. If you're in life sciences kind of a company, or these kinds of companies, you're not going to necessarily be cooking up these things in your garage, right? You require a large capital investment up front. So valuation, I think it can be all over the place, but the key things to keep in mind are, one, are you getting a valuation that lets you give up equity that you're at a percentage that you're happy with? So if you envision having 3 or 4 rounds of financing, as sort of the typical ranges, I think Craig talked about, for a Series A financing, 25 to 45% or 20 to 45%. And then sort of successive B, C, and D rounds of financing are probably in the neighborhood of 15 to 25% if I had to take a guess. What are you going to end up with at the end? And then it gets really complicated when you start leveraging in the liquidation preferences. But that's important to keep in mind, because at the end of the day, if you don't agree to a deal that you're happy with, even if you love the investors, I've seen this with other people, it's going to eat away at you. You're going to feel like you gave up too much, or you're not happy with the terms, and so then you're going to end up fighting for everything in successive rounds of financing, and that's not where you want to be. What you really want to be focused on is how do you increase the valuation of your company, not how do you hold on to little bits of equity here and there, because you want to be able to be generous with the people that you bring on board, and those kinds of things. So I know a lot of people tend to focus on valuation. We didn't, and it still worked out just fine for us.
Now, one of the things to keep in mind here on the pre-money valuation is, and maybe we should step back and say, what is a pre-money valuation? What's a post-money valuation? All the pre-money valuation is what the company's worth before you raise the money. So in this term sheet, we said the company is raising $2.5 million at a $5 million valuation. So the pre-money valuation is $5 million. The company's raising 2.5, so 5 plus 2.5 is 7.5 million is the post-money valuation. The investors will have put in 2.5 out of 7.5, so they will own 1/3 of the company. So that's a pretty typical first-round financing. $5 million is pretty middle of the road for a valuation. The investors owning about 1/3 of the company post-financing is pretty typical. Now, one of the things that in particular you need to know that you can negotiate, that you wouldn't intuitively think is part of the valuation conversation, is the option pool. And so, the option pool is not on this first page. In fact, I didn't even put a cap table on this, and I should have put a cap table here. But normally, the investors are going to say, you need to have an option pool of at least somewhere between 15 and 20% of the company available for grant to new employees post-financing, so out of the post-money valuation, or out of the post-money percentages, but that entire option pool counts against the pre-money valuation. So the founders of the company have to take all of the dilution from that increase to the option pool. So if you're selling 1/3 of the company to your new investors, but you have to have a 20% option pool post-money, that means you need to have about a 28% option pool pre-money that then gets diluted down to 20% as part of the financing. Not sure my math was quite right there, but it was close. And if you're able to negotiate that option pool, the size of the option pool, you're negotiating your pre-money valuation. It doesn't look like it. The pre-money valuation is still $5 million, but an option pool of 20% versus an option pool of 10% has a huge impact on the ownership of the founders. So there's not just that one leverage to pull. It's not just a matter of saying the pre-money valuation is $5 million. No, it has to be $4.5 million. Often the way that the valuation is really being negotiated is through the option pool. If you can shrink the option pool, you're effectively increasing your pre-money valuation. That's really important to keep in mind, and it's not intuitive at all.
Yeah, what I suggest doing is you got to build a spreadsheet, or there's a number of them out there, or you work with counsel that can provide you with one, and you play with the numbers. This 15 to 20%, I know it's a rule of thumb. I think it's a little bit outdated. A lot of companies now are more efficient. Just to, the two examples that I like are Instagram and Dropbox. Instagram's got 6 people, 12 million users. Dropbox has 60 people, maybe 70 people now, and I don't know, they're 150 million users, something like that. I mean, they're doing a great job. So what my point is if you don't have to build out a huge team, you don't necessarily need to have a huge option pool. And the kinds of negotiating things that you can do in this discussion is to say, look, we expect between this round of financing and the next round of financing, our company will grow to such and such size. And we expect to have these kinds of hires, and this is a typical equity range grant for these kinds of hires. And then you want to give yourself a little bit of wiggle room. And you give yourself the wiggle room, and your investors will want the wiggle room because you may run across some kind of superstar that you want to bring into your company. Whether that's a superstar CEO or a VP of marketing or someone who's going to just have an exponential impact on the business. And to incent them and bring them in, you want to have the flexibility to give them 2, 3, 4, 5%, whatever it is makes sense for the kind of role that you're talking about. What was successful for us in particular was actually negotiating this option pool because I was able to make a strong argument about why we were going to build a very efficient business. That's how you go about hiring, that's how you go about building the product, that's how you plan to go to market. And I fundamentally held that your option pool should be sized to the financing and the next milestone that you're going after. And not all investors feel this way. Some investors will come back and say, well, we want you to allocate the option pool up front and have it last with a few rounds of financing. I think the counter to that is that, look, dilution in subsequent rounds of financing isn't good for anybody if we can help it. And everyone is more well aligned if you have a pool that's sized for that particular round. So that when you go to the next round and you're thinking about how's the company going to grow at that point, your investors who will more likely than not be on your board are thinking about it from a very similar perspective as you. Right? And I think that can make a pretty material impact in the discussion on valuation and the size of your option pool.
Yeah, and typically the way you do this negotiation is you're doing a bottoms-up analysis. So the investors are going to tell you need to have enough options available for all the employees you're going to hire in the next 12 to 18 months. And so if they tell you, we think that's 20% because we're VCs and the rule is 20%, or maybe we'll go down to 15%. If you can build a spreadsheet and say, here are the people we're going to hire, this is how much equity we're going to allocate to each of those people over the next 12 to 18 months, and it adds up to 7% of the company, you're going to be able to justify a smaller option pool, which again is going to increase your valuation without changing the number that's on the page for pre-money valuation. Okay. Any questions on valuation issues?
So your company was pre-revenue. You went to the VCs. How did you build a solid valuation off of pre-revenue company?
We did. I think so. There are pros and cons to raising different kinds of money at different stages of your company, right? So if you and your team are smart guys or gals that are well suited to go tackle a particular problem and you're really valuation sensitive, maybe an angel path is more appropriate than a VC path. My take on why we went VC, even though we were pre-product, we're more of an enterprise play. We're more of an IT play than we are a consumer play. And I was interested in the staying power of investors through ups and downs of the financial markets and all this kind of stuff. And I've seen this firsthand with friends of mine that have started companies, raise money from angels. The market dips 15%, the market dips 10% over a few-month period. That affects the ability of your angel investors to write follow-on rich kinds of checks when you need to buy yourself time because maybe it's taking longer to get to a milestone, maybe it's taking longer to close your next round of financing. So that's a little bit of color on that. I think you talk to counsel, you figure out what the market is. You talk to other folks, you figure out what the market is. Most people are very sensitive about talking about the valuation of their particular company and that kind of thing. If you have other friends that you can have that kind of candid conversation with, it'll help you out quite a bit. But I don't know that there's a great model for building up this bottoms-up analysis of my pre-money should be X, even though I have no traction, no product, no revenue, nothing like that shit. I'm just an awesome person. That's why I should be. It only gets you so far. I mean, sometimes it works, sometimes it doesn't.
Do you have any formula for the founder's money that goes into the business?
So when the company is first kicking off and the founders are starting the company, So some lawyers will say, yeah, you got to pay real money and you need to have $10,000 or $100,000 in the bank. Normally, when we're advising a company starting out, the founders of a company starting out, we say, you've got a sound check. You've got a business plan that you developed. You may have written some code. You've got some IP that happened before you incorporated the company. We're just going to set up a stock purchase agreement so that you are giving all the IP that you developed to date, the business plan, whatever code you've written, to the company in exchange for your stock. So normally we have nothing, no cash paid at all.
So if the cash that you invest in the business and you get it along, that just moves.
Yeah, so there are a couple ways to set it up. Often we set up the money that the founders put into the company. If you're going to put in $50,000 or $100,000 of your own money, we'll often say, do your founder stock for free so you don't mess up the valuation for other people you want to bring on board, and then do a promissory note, do one of these bridge notes. And if you're going to bring in other investors later on, we've been doing this a lot lately. The founders put in $100,000 of their own money on very standard bridge terms with a 20% discount, and then it's easy to go out to other angel investors and say, look, it's good for me. I invested on the same terms. Here are my terms. Invest on the same terms that I invested in my own company, and then we'll all convert at on the same terms.
Yeah, I've got a friend who did this, and he was able to hold off dipping into that money until he got the other investor on. So he was able to let the investor kind of set the terms. And it's part of a discussion, but basically he didn't have to dip into that money, and so it looked like he was, from a timeline perspective, it looked like he was investing alongside the investor. And there are advantages to doing that, I think.
Is there such a thing as getting a third-party valuation for like a Series A? I know later it's appropriate, but for earlier stage.
In order to set the terms of the financing?
Right. To have in order to set valuation of the two.
Yeah, normally we wouldn't see people hire a third-party valuation firm to set the valuation for the investors, because as we're talking about, this valuation exercise is really a reverse engineering exercise of taking the amount of money you're raising, going to the percentage ownership that you want. And you can't, when you're doing a Series A company, as Giri was just talking about here, you can't apply multiples of revenue. You can't say, okay, you have zero revenue, and companies in your space have a 20x multiple on revenue, therefore your valuation is zero. And you can't do the same thing with, and maybe in theory you could do it off projections, but even typically at this stage, your projections over the next 12 months, 2 years, sometimes longer, are still zero revenue, negative income. So it's just a negotiation based on how much money is being raised more than anything else. And sort of comparable companies, and you can see in the materials I handed out in the glossy that you can see what typical valuations have been. We can break down that data for different industries and say, okay, you're doing a software as a service company, Series A, raising $3 million. What do valuations look like in comparable companies over the last 12 months? But getting a third-party valuation, normally your investors are going to say, we don't care about that. It doesn't mean anything.
Yeah, I think the one thing I'd add is when you get the spreadsheet and you sort of run through the numbers, think through, there will be a huge difference in what your pre-money valuation is on a term sheet if you're going through 20% dilution versus 30% dilution. But if you actually run that out in a model and you say, well, I'm going to sell my company or we're going to go public at a certain period of time and this is what the valuation is going to be at that point in time, and to get there we're going through this many rounds of financing and this much dilution, the difference between 30% and 25% or 30% and 20% becomes trivial over time. And it's going to be, if things go well, it's going to be money that you don't care about. And if things don't go well, it doesn't matter.
In terms of the ESOP, I'm dealing with a portfolio company. Trying to explain this to me beyond this little always entertaining. Have you seen, I've never seen it actually done, but have you seen in sort of aggressively pursued financings where the founders will negotiate some kind of radical triggering of the unvested ESOP pool that reverts back to the founders and the investors and selling a set percentage as a negotiating point for setting that percentage pool successfully?
I've seen people talk about it once, and they didn't end up doing it. So I've done a couple of deals where there was pretty heavy dilution in a Series A, and often more in a Series B, where the investors may agree, we'll grant you further options that don't have time vesting, they have milestone vesting. So, we think your value, the investors are basically saying, you founders are telling us that you think you're going to achieve the following milestones, and you think the company should be worth more than we're agreeing it's worth today. We'll put your money where your mouth is. We'll give you more options, and if you hit the milestones you say you're going to hit, then those options will vest. I have not seen that. It seems like a bad idea. Yeah, well, I've only seen it happen once.
Yeah, I think in general rule of thumb, get everything written down. Yeah, I wouldn't. I mean, you always want to bring people around the table that you trust and you want to work with in the relationship, but everybody is best served by having things written down.
Yeah, memories change and people leave. It's not unusual for one partner at a venture fund to be the board member initially, and then that board member ends up leaving, and all of a sudden you're dealing with somebody new, and the person can say, I don't care what that person said.
Or you have a successive round of financing that's not an up round, it's a down round, or it's a flat round, and maybe a new investor comes in because they think it's a steal, and then none of those discussions matter anymore. I think I would write everything down.
Okay, great. Anything else on valuation? Okay, let's talk about the next term. This one's going to be a short conversation, but a really, really important conversation. Dividends. Dividends should not matter. So every term sheet will say there are 8% dividends. That magic 8%, I have no idea why. It's still 8%. Every preferred stock deal has 8% dividends. Or almost all of them have 8% dividends. Sometimes they're 12. In most deals, dividends should not matter because of one word, NON. On a deal today where the company's been around for a long time. We became counsel of the company after the company was founded, and it's an East Coast VC. They have a cumulative dividend. We're selling the company right now because of the way that the cumulative dividend was structured. The investors in the company are going to make somewhere between a 3x and a 4x return on their money. So for every dollar they put in, they're going to get around $3.50. The common stock is getting zero. And it's all because of the dividend. So you don't pay much attention to that word cumulative. It's all because it was missing the NON. If the NON had been there, the common stock would have made millions of dollars. Millions of dollars.
I think you may want to add that it's like a 9-figure kind of a deal. This is not like a 7-figure deal or 8-figure deal. It's a big.
Yeah, this is a big deal. This is a over $100 million deal. Yeah, go ahead.
So, is this the dividend rate is 8%? Is that per annum?
It's per annum.
Okay. And then, so the dividend reference is the original purchase price plus accrued dividends.
Yeah. And so the magic is if it's non-cumulative, they don't accrue. So when you get to selling the company, with non-cumulative dividends, dividends are payable only if the board declares dividends, and the board of a venture-backed company never declares dividends. So when you sell the company, you have to pay the original money they invested plus any accrued dividends, but there aren't any accrued dividends. Okay. Now let's get into the meat of the money, liquidation preference. Okay, this is on page 2.
I just remembered one thing about valuation that I wanted to add. In terms of this conversion, and milestone-based grants, we didn't talk about tranches. I mean, tranches are another approach where you can get an investor to say, yeah, we believe that some things that you can do, but we want to stage it. We want it to be milestone-based. And it's in some ways a little bit like high-resolution financing, because what you're agreeing to with your investor is we'll take a certain amount of money at a certain price, we'll reevaluate against a milestone that's been mutually agreed to, and the follow-on money in that tranche is invested at a different price. That's my high-level understanding. We didn't do it, so I don't know the details of it, but I have some friends that have gone through that, and we've talked about it, and you probably know more than I do. But I think it's another interesting approach where you may be able to tip an investor who's on the edge. Let's say you want to raise a certain amount of money, they're not comfortable with it. You may be able to break it up into pieces and say, well, why don't we do a tranche? That can help push them over the edge.
Yeah. And I'd say in biotech deals, we see those tranche deals almost all the time, because it really, with a biotech company, it's really easy to say, these are the milestones we need to hit. Yeah, we're going through an FDA approval process, and we can define what the various milestones are. Everyone can agree on day one, these are the milestones we have to hit because it's regulatory driven. And it can't be changed. You either hit these milestones or you're dead. With other tech industries, it's harder to do milestone tranches, other than maybe hiring a CEO. And we often see, for an early stage company, hiring a CEO is a milestone, where the founders agree with the investors, and everyone says, we're going to bring in a high quality CEO. And the investors say, well, once you bring in that CEO, we'll put more money in on the same terms, because we want to make sure the CEO is comfortable when he or she walks in, that there's enough money in the bank to keep going. So incentives are aligned. To try to have other types of milestones for a non-biotech deal is hard, because in a typical early stage company outside of biotech, your milestones change all the time. What you thought your business was going to be when you raised that Series A often is very different than what the company looks like 12 months later. So it's hard to do milestone deals. Great. Let's talk about liquidation preference. So we've been talking about money issues. This is the number one money issue. And I said earlier on, the concept of liquidation preference is very simple. The investors put in $1 million. The first $1 million that comes out in the sale of the company goes to the investors. So that's a simple concept. Liquidation preference is the holders of the preferred stock, the investors get their money back first. But then there are various flavors of that. And this is where term sheets are almost always negotiated. It's very rare that this provision is not negotiated. Because normally the investors will say, we get our money back first, and then after we get our money back, then we'll share with you. So we own 1/3 of the company. We put in $2.5 million in this term sheet. We get the first $2.5 million out, and then let's say the company sold for $10 million. There's $7.5 million left over. The investors own 1/3 of the company. They'll take 1/3 of that $7.5 million. So the investors will have received $5 million. The founders will receive $5 million for their 2/3 of the company. You can have, this is called a participating preferred. It means that the investors get their money back, and then they participate. Then they continue to receive money with the holders of common stock. Often you can negotiate these deals so that it's non-participating preferred. The investors get their money back, they get their $2.5 million back, and then they're done. They get no more money. Now, the way that they get rich is if the company sold at a good valuation, they'll just convert their preferred stock into common stock. And everyone's in the same boat. Everyone receives the same amount of money per share. And that's great. Everyone's aligned. With a fully participating preferred stock, where the preferred get their money back and then continue to participate and receive proceeds along, the preferred stock is always worth more money per share than the common stock, regardless of the valuation. So one way to negotiate this, a fairly common compromise, is what's called a participating preferred with a cap, where the preferred gets their money back, then the preferred and common share, and then once the preferred is received maybe 2 times their money back, a 2x cap. So once the preferreds receive their $5 million back, they no longer participate. They're done. And they won't receive any more money. All the money goes to the common. If you can build a spreadsheet out, what that means is that at some point, the preferred is actually better off converting into common stock because they'll make more money per share by converting to common stock. If the company sold for $100 million, they'll convert to common stock. Now, one of the important things to keep in mind is what that does is it creates a zone of indifference, which means if you've got a participating preferred with a cap, if the company sold, in my example here, if it's a 2x cap on participation, and the company sold for $10 million, then the preferred gets their 2.5 back, then they get 1/3 of the 7.5, they got $5 million back, then they couldn't care less. If the company sold for $11 million versus $10 million, the preferred is still receiving $2.5 million back. And that actually drives, or receiving $5 million back, excuse me. That drives behavior. The investors are doing the math and saying, you know, hey, management, the founders are going to get all the money between a $10 million deal and an $11 million deal. We're getting the same amount. We couldn't care less. You know, good luck to you, management, in negotiating those terms. And so you need to be thinking about these issues when you get to a liquidity event, when you're selling the company, on how the money's being split, because it does affect people's behavior.
Yeah, I think this was probably one of the most eye-opening things for me when we were going through negotiations. And it's not just because when you're doing it for an early-stage investment, whether it's a seed or Series A kind of a deal, you think about it and you're like, well, if I have to worry about this problem, zone of indifference, we probably didn't do very well. We didn't have a great outcome. But I think where it starts to become very important is when you actually set the terms in your Series A, what you're doing is you're signaling for subsequent rounds of financing. So anyone who comes in at a B or C or D, they're going to want that. You've set the bar, and they're going to want something beyond that. And so the range of indifference starts to become much more significant when you're at a B, C, or D stage of the company. And so that for me was particularly eye-opening. When I ran through the numbers, and I was like, well, let's say we do this much money in a B round, and then we have some kind of exit after that. That range of indifference grows significantly, and it can be very problematic in terms of balancing the investor interest against the founder interest. And so it's something to keep in mind. And I think you talked about what's market. I think market's it's 2x with a cap. I think if you have competition for your deal, you can do better than that.
Yeah, and you can look at the data. This data is all in the glossy that I handed out. And I think you'll see in the last quarter that roughly 1/3 of deals were participating, 1/3 were non-participating, and 1/3 were participating with a cap. But if you look, earlier stage deals tend to have more founder-favorable terms. As Giri said, it's really important to keep in mind that the terms are never going to be better to the founders than they are in the Series A. They only get worse. So the liquidation preference may be uglier in the future, and you got to keep that in mind. If you've got a participating preferred on your Series A, your Series B and your Series C are going to be fully participating.
Yeah, I think there are some exceptions. I think generally they do get worse, but there are some crazy exceptions, like the ones you read about on TechCrunch, right? Like Airbnb and Zynga and all these guys that have. But those are definitely not the norm.
Yes, if you're confident your valuation will be $1 billion within 18 months, don't worry about any of these issues. It'll all be really easy. Okay, so that's it on liquidation preference. Any questions on liquidation preference? Well, let's talk a little bit about voting issues. So we said it's all about money and control. Let's turn to some of the control issues. There are two primary control issues. The first are the protective provisions, which are on page 4 of the term sheet. You got a whole page of them. It's exactly one page. These are all the things where your investors have a block. Your investors can say no to things. These are really important, in part because we said we're going to talk about what's negotiable and what's non-negotiable. The most important protective provisions are non-negotiable. A VC that owns more than 20% of the company will always have the right to say no to a future financing on same or better terms. They'll always have the right to say no to a sale of a company. So even though in this example the investors only own 1/3 of the company, they don't own a majority of the company, they can prevent the founders from selling the company. And they can prevent the company from raising financing in the future if they don't like the terms. those are non-negotiable with venture capitalists. With angel investors, you can negotiate those terms. So it's one of the biggest differences between an angel and a VC financing is that angels will often agree that, hey, we only own 15% or 18% of the company as a group. We're not going to have a block. If the founders want to sell the company, the founders can sell the company. If the founders want to raise the next round of financing, they'll be able to negotiate that, and the founders can't, the preferred investors cannot block that financing. So really important to keep in mind, and those are the two most important. There's a long list of things here that are typical in a term sheet. Some of this is negotiable around the edges, but those are the two that really do matter and really are not negotiable.
Yeah, and so this is why it makes it really important to diligence your investors. They're going to do diligence on you, and it's not just the firm, it's going to be the partners that you're working with. It's extremely important to understand what their pattern of behavior has been in the past, what their philosophical approach is, how they think about exits at early, mid, and late stage companies, and how that relates to you and what you think your trajectory will look like, because it is a partnership. And so, to Craig's point, because these are not negotiable, you need to kind of understand how they're coming, how they're going to approach some of these scenarios, because they may happen, and you need to understand how you would expect them to behave a little bit. It can make a big difference in terms of who you decide to work with.
Okay. Now, the other important control issue that's actually more important than these voting issues, because as I said, they're really not terribly negotiable with VCs. What is very negotiable is what your board looks like. And who is on your board is really, really important, because the board controls the day-to-day decisions. If a founder is going to be fired, that's a board decision. And so you need to make sure that you're comfortable with who's on your board, and you need to make sure that you're comfortable with how those board members are elected. Now, normally, your board ought to mirror the shareholdings, because the board members really are representatives of the shareholders who are elected to act in the interests of all shareholders. Now, even though board members have a legal fiduciary duty to all shareholders to act on behalf of the best interests of all shareholders, they're often they're sitting in a boardroom as a board member, but they're also often there as shareholders, and they'll go back and forth. Board hat, shareholder hat, board hat, shareholder hat, going back and forth about how they're thinking about an issue. And we'll often have, I'll say to a board member as company counsel, what you just said, weren't saying that as a board member, you were talking as a shareholder, right? Because what you just said is in your preferred stock's best interest, but it's actually disadvantageous to the other stockholders. You need to be thinking about which hat you're wearing. That therefore makes a big difference in how your board is structured, how the board members are elected. If your VCs own 1/3 of the company, they would typically have 1/3 of the board. If your board members own if your investors own 60% of the company, if you've done a Series A and a Series B, and between the two rounds they own 60% of the company, they're typically going to have more than a majority of the board members. And once they have control of the board, they can decide, hey, you know what, we don't like the founders anymore, we're firing the founders. So that is the most important control lever, is who is on the board initially, who can take board members off, and who can add board members.
Yeah, and so I'll reemphasize the importance of diligencing your investors, because you want to take a look at their track record. Do they like to bring in professional CEOs? When they do that, how do they handle the founders' roles within the organization? And the only other thing I'd add to what Craig's saying is, as much as possible, just try to keep it simple. And I think that's true for the entire term sheet, but particularly around the board. The simpler that you can have it, the more manageable your board will be, the less time you will spend on things that you don't need to spend time on. The board is a huge deal, and it's probably, I think, at least for me, it was probably one of the things that I underestimated the most coming in. I knew it was a big deal, but it can be a big time commitment. But more importantly, it can really help your company move forward in the right direction if you've got the right people and all those kinds of things. So I'm happy we spent a lot of time on that up front, and it's certainly helping us out right now.
Yeah, I mean, I've worked with lots and lots of venture-backed companies over the years, and I've seen far more venture-backed companies fail because founders and investors ended up hating each other than because products didn't work. And so who's on your board? I can't emphasize more, not just because of the voting issues and how decisions are made, but if you got a dysfunctional board, if you have 5 board members, but you got a CEO founder and 1 preferred stock investor who hate each other, the company is going to fail. And I've seen that happen on a regular basis. So it's really important to know who's on your board.
Does your board have to be comprised of all investors, or can you pick trusted advisors, business associates?
Yeah, often the board is composed of a mix of the investors, founders, and outsiders. So it's not unusual for a Series A company to have only investors and founders. Now, a typical Series A board is 3 members, 2 founders, and one investor. But as the board grows over time and as the company grows, you want to bring in more and more independent voices into the picture.
I think one of the harder things to pull off, and probably one of the smartest things to pull off if you can help it, is to get an amazing independent board member before you go raise any money. It'll help with the board composition discussions. I mean, in addition to all the advice and sort of general goodness of having a strong independent, but it'll help with the composition of that over time, and I think it bodes very well for the company in general, I think. So.
Okay. Anything else on control issues? Let's talk about one very quick economic issue, redemption. This is on page 2, and what the term sheet says is the preferred stock is not redeemable. What redemption is the right of the investors. Sometimes it's the company's right, but normally it's the investor's right to demand their money back. So after 5 years, 6 years, 7 years, the investors can say, okay, we're tired, we've had enough, give us our money back. And sometimes it's give us our money back plus a guaranteed return. So it can be negotiated as just protection, downside protection, to make sure they can get their money back. But sometimes it's more than that. Sometimes it's a way for themselves to guarantee not only their money back, but also a positive return. This is one of these East Coast, West Coast terms where on the West Coast it's pretty unusual. There aren't very many Series A deals done by West Coast VCs that have redemption. It is very common on the East Coast. And when you have it on the East Coast, there's often a guaranteed return where there's a cumulative dividend that's adding up. Sometimes I've even seen investors ask for the right to be bought out at fair market value, that you would go out and get an appraisal. And then the company would have to pay cash to buy out the investors at the appraised fair market value, which only works well if your company has good cash flow. If your company's not going to be profitable for a while, that's just not going to work.
I don't have much to add on this. I mean, I think it's thankfully on the West Coast it's pretty boilerplate and it's founder friendly.
Okay, I think we have only a couple more minutes left, and I wanted to touch on some of the founder issues that relate to control and ownership both. Founder vesting is something that typically is negotiated in the term sheet. When you set up the company, normally you should be setting up the company so if you've got more than one founder, you've got vesting on your stock, meaning if you leave the company has the right to buy back stock that hasn't vested because you haven't been there for a period of time. Normally you have 4-year vesting. So if a founder leaves after 2 years, the company would have the right to buy back half of that founder's stock at the original price the founder paid, which normally, as we talked about earlier, is 0 or close to 0. So that founder vesting is really important. When you get into a financing, that can be a heavy negotiation point. When investors are investing in your company, they want to make sure that you've got an incentive to stick around. They don't want the founders to be 100% vested or even 3/4 vested on day one and be able to walk away from the company after the money's been raised and sort of hand the company over to the investor and say, thank you for investing, here's your company, let me know how it turns out. They want to make sure that you got skin in the game, you're going to stick around and stick with it. So the vesting terms often are negotiated in the term sheet. Ideally, they're negotiated in the term sheet. Sometimes it gets negotiated post-term sheet. The term sheet's been agreed. No one's talked about founder vesting. And then in the negotiations of the final documents, it gets negotiated. And that's a tough negotiation.
Yeah, I think that there's sort of 2 things that you can balance. One is what is the start date of the vesting. So you may have been working on this for 9 months before you show up into an investor's office, and you may believe that you've done all these great things. You'll find that this is a point of negotiation. And then I think the other is, how much do you start off with up front, and then how does the balance vest over time? Is it a 2-year vest, a 3-year vest, a 4-year vest, or potentially longer? So those are the 2 points that I think you can negotiate. And I've seen in several deals around town the start date being negotiated. It happened to us, and it's happened to other people as well. So it's something to keep in mind, and it will affect how you think about things. So you'll have to take a step back and say, well, I've already put a year into this. Am I going to put another 4 years into it? And when you're in the heat of it and you're in love with what you're doing, it's different versus how you think about, okay, well, time's ticking. Like, what are we going to do now? So.
Okay, one last control issue that I want to talk about real quick was a drag-along. A drag-along means that the investors can force the common stockholders, typically the founders of the company, to sell the company if the preferred stock wants to sell the company. So we talked earlier about the protective provisions, which are the investors' rights to say no to certain things. This is the flip side of that, because keep in mind, in the structure we talked about, in this term sheet, the founders own 2/3 of the company, and the investors own 1/3 of the company. When you're just voting on a normal basis, the founders could always outvote the preferred. So the preferred had their protective provision. They can say no to sell the company. But the common owns 2/3 of the company, so they can also say no. So even though there's not a preferred stock protective provision, just based on the numbers, the founders had the ability to say no to a sale of the company. If you've got a drag-along provision, a drag-along says if the board and the preferred stock approve it, then everyone else has to vote in favor of that transaction. They can't say no. So a drag-along is a really important provision, and it can be really problematic in a Series A deal. And I typically tell founders, never agree to a drag-along in a Series A deal because you're giving up complete control.
Yeah, I think the way that Craig and I had talked about is if you can narrow the scope of drag-along to a class of stock, right? So if you have a number of Series A stockholders or a number of Series B stockholders, and some are in minority, some are majority, you may want to have the majority holders in a particular class to be able to decide we want to do a certain kind of action and drag along the rest of the folks in that class. That can actually simplify things considerably depending on what the distribution of your investor pool looks like.
Yeah, and often if you've got a drag-along in a Series A, often it will be, the board has to approve it first, but the founders have 2/3 of the board. So the founders effectively do have a veto. What it means is that if you've got 5 founders and one of the early founders leaves, everyone else can force that little founder who's gone to vote in favor of the transaction. So it can be really helpful to a founder as well. It can cut both ways.
Talk about single trigger, double trigger.
Yeah.
Okay. So this is another thing that's important for founders. I think I may have a little bit of a non-traditional approach. I think a lot of founders would love to just say, "Oh, I want a single trigger provision," and then you get into this back and forth with an investor who investor will never be comfortable with that. If you anticipate some kind of M&A for your company, I think it ends up being renegotiated anyway. But you signal to your potential acquirer how you think about staying on if you have a single trigger or double trigger provision, and then what the acceleration looks like. I was actually, when I thought about it, I didn't think a single trigger made sense for us because I didn't want to signal that, hey, we're just going to drop this and run away, because I wanted to see what it is that we're working through. So then I think it just becomes a matter of what percentage accelerates. And so double trigger basically means that there has to be 2 kinds of changes that happen. One is a change of control, and the other is you're no longer there. And so depending on those, and there's a time horizon that's associated with that too. So it will make you think about what those exit scenarios look like and how meaningful that is for you relative to your equity. And investors will, they want the company to be marketable, whatever that exit ends up being, and so they will have a particular position on how they think about what that acceleration looks like. And so I think it's a very negotiable point, and it's something that I would encourage you guys to think about with respect to the sort of how you see your company evolving over time and what kind of outcome you want to have.
Okay, I think we've gone beyond our time. Does anybody have any more questions before we finish up here? No, we're beyond our time. Connie has a question.
So really it's board composition that can sink you faster than anything else?
Yes. Board composition, I think, is one of the most important things in the term sheet. And it often is not negotiated at all, and it should be really heavily negotiated because they're the mechanical questions of how board members are selected and how they can be removed. And then there's the actual people. Who are those people who are on your board? And if you've got the wrong people on your board, that can really kill a company.
Well, people talk about their VCs. So if I'm looking at an area VC and I want to ask around
Depends on who they are.
So I certainly did a lot of diligence on all the folks that we looked at working with. And so what I'd recommend doing is you want to ask the folks that you want to work with for references. And you maybe want to talk to a couple of those, but you also want to talk to people that you know they've worked with that they didn't give you as a reference. And you want to know why. And sometimes the potential board member will tell you, these are people that we worked with and this is what went well. And these are people we worked with where things didn't go so well. And we overweighted conversations where things didn't go well because we wanted to understand, because it's not a smooth ride. And so you want to figure out, who can you work with when things aren't going well. But to your point, it's a very sensitive topic, and it helps if you actually have prior relationships with folks that you want to get that feedback from, as opposed to just asking people to wing it and tell you. I think that it's a very sensitive topic.
Okay. Well, thank you, everyone, for coming. We appreciate your attending.